Morning everyone, and thank you very much for joining me. Today is Tuesday, it's the 7th of June. This is the morning market review. My name is Russell Shaw, and I'm a senior market specialist at FXCM. Here's my email address if anyone needs to get hold of me, rshaw@fxcm.com, and I'll respond as soon as I'm able to. Here's a high risk investment warning. I'm just going to keep this on screen for a few moments. Then I'll bring up our commentary disclaimer, excuse me, our references, and then we'll get into the analysis. Hey Anna, hey Rob, morning to you guys. Thank you very much for joining. Yes, I'm well. Hope you guys are well too. Thank you everyone for joining. Rob, thanks for that link. Rob sent me a link yesterday. I haven't actually explored the site, but it's to do valuations. I'll just pop the link. Just pop the link in the chat if anybody wants to have a look at it. I haven't really explored it, so thanks very much. How did we compare with their Apple valuation? Be interested to know. Here's the market commentaries disclaimer. I'll just keep this on screen as well. So that link now is in the chat. Thanks for that, Rob. All right, and here's our references. So we'll do MarketScope 2.0 for the analysis. I'm going to start off with the CNBC.com. I will take a look at TradingView as well, specifically the fact that the yields are starting to move now, right? So just want to have a chat. I just want to have a look at that. All right, let's go through the CNBC morning report. So you just go to cnbc.com, look for the European markets report, and it reads as follows in terms of headline: European stocks are heading for a lower open as inflation nerves grip markets. And that was something that Anna brought up yesterday. What about inflation, right? So you can see, Anna, still very much a market theme there. Let's see what the article says, and then I think that whole conversation probably fits in quite nicely with the US 10-year or even the German Bund. But the article reads as follows: European stocks are expected to open in negative territory amid nervousness over inflation, with the next reading of US inflation due at the end of the week. So that CPI numbers coming out on Friday, I believe. International markets are gearing up for key US data releases this week, including the latest inflation reading on Friday. Yeah, there we go. May's consumer price index in the US is expected to be just slightly cooler than April, and some economists are expecting it could confirm that inflation has peaked. All right, so that, just by the way, that opens up a huge discussion. So if we have peaked, if we have peaked, and we might have, my feeling is if we haven't peaked, we're pretty close to the apex. So but the next part of that discussion is, well, how quickly can we come down to the 2% target? Okay, so are we plateauing, or are we starting to, have we actually hit the turning point, right? The next data point, the University of Michigan Consumer Sentiment Index, also due Friday, is going to be watched by investors. I really find that an important index. It's really depressed at the moment. Consumers, in terms of sentiment, have been they really sort of in a low mood in terms of a consumer sentiment. We did do an analysis on the consumer possibly a week ago, possibly 2 weeks ago. So I'm very interested in that reading as well. The UK trading session will be interesting to watch on Tuesday. Amid political turbulence in the country on Monday evening, UK Prime Minister Boris Johnson survived a vote of confidence triggered by his own lawmakers amid increasing dissatisfaction in his leadership. Some 211 Conservative Party lawmakers voted in favour of the Prime Minister on Monday, while 148 voted against him. Johnson needed the support of a simple majority of 180 MPs to win the vote, but the figure of 148 was worse than many expected. It is also worse than the result of a similar vote that former leader Theresa May faced in 2018. She resigned as Prime Minister just 6 months later. It's a quiet day on the data and earnings front in Europe, although Germany's latest industrial orders figures are due to be released. All right, so that's CNBC. Yeah, okay. So Rob, just saying he didn't see the YouTube replay yesterday. Okay, cool. Yeah, I'll put yesterday's. I'll upload yesterday's webinar. So yesterday I was actually offline almost the whole day. Serious sort of IT issues in terms of connecting up to our, the FXCM hub. So I only really came online right towards the end, and even then there's IT issues. But I got an email this morning, everything's sorted. So I'll upload that, Rob, with this webinar as well. Okay. All right, let's take a look at the yield here, and again, I want to bring in the conversation that we had yesterday. I wasn't particularly happy with the way the webinar went yesterday. From my own point of view, it was overly complex. But the key question is, there's still risks in the market, and I would agree with that. I would agree with that. I guess inflation was a key theme that was brought up, but I would also suggest it's more than that. I would suggest, well, what about stagflation? And I'm not sure that we've got past that yet. So, and stagflation, of course, includes inflation, but it includes contraction as well in economic activity. So what we have here in terms of the 10-year is something that we've spoken about. Now it's happening. I want to bring up the RSI here as well. Let me just bring that up. All right, so the interest rate moved to a high of about 3.2% very quickly. It was a very rapid and a steep movement up. So it went from sort of 1.7% to 3.2% in, I think it was about 7 weeks or so. And because of the just the rapid ascent, the RSI, excuse me, the RSI went overbought. And one of the, I think, aspects of an overbought market is, well, it probably puts a cap on how much higher we can go, because we overbought. There's so much heat. How would that work in terms of simple market mechanics? What's the mechanism that would release the froth, so to speak, on the yield? Well, don't think of it in terms of the yield. Think of it in terms of if you are a bond trader. So what we can do is we can go to something called IEF. IEF's an ETF. It's an exchange traded fund. Okay, so iShares, and it's the 7 to 10 year, which is probably the best measure we can get for this time frame that we're looking at. So let's just bring up the IEF, and what you can see here is IEF's getting sold down just at the time that yields get overbought. That makes complete sense in terms of your formulas for the bond market. We know that yield is inversely related to bond prices. So if yield's increasing, bond prices are coming down. So where's the adjustment taking place? Well, let's let's assume the adjustment's taking place on the price side. So this is the chart to look at in terms of that adjustment. So if you're a market participant in terms of bond prices, okay, and let's go back here. So this is kind of the lockdown period. So since then, bond prices have been hammered. If you are a market participant, clearly you're making money on the short side, okay? If you are what we call trading the market, if you're holding to expiry, it's a slightly different scenario, but the bond market's heavily traded. So there's net short positions. There have to be net short positions here because there's an excess supply. How do I know there's an excess supply? Price is going down. Now, if you are a short, let's just say you entered a short position here, okay, and then you see that the market is oversold. Well, you've just made. Let's just say you've taken a heavy position. Let's say we're talking sort of millions and millions, right? Well, then you've made a nice tidy sum. It's time to bank it. It's time to bank your profit. Market's overdone, so you cover your position. Covering your position means you're buying back. Okay. If you're shorting, you've sold. To cover your position, you've got to buy back that position. So that buying back the position creates demand. That demand causes price to appreciate. What's happening on the yield side? Yield side, remember, it's inversely related, but the pressure's being released. Pressure's being released on the yield side, and that's what I think's happened there. Now, I did hear commentary saying, well, perhaps the fact that we had this pullback here suggested that the Fed may not be able to move as aggressively and as quickly as initially indicated. And of course, that could be a viable hypothesis. That the Fed, to be quite honest with you, the Fed's in a terrible predicament here. If it's aggressive, it's not. It can't avoid a hard landing. How hard a landing it's going to be, that's debatable. But it's a predicament when you're in a stagflationary environment. Policymakers are in a they're between a rock and a hard place. So this pullback here is saying that the Fed can't go as aggressive as it wanted to. That's a very good argument, and it could be true. But in terms of the technicals, price doesn't move in a straight line. Price moves in peaks and troughs. Impulse, correction. Impulse, correction. That's what we call the heartbeat. Is that right? Right, the pulse of the market. 1, 2, 2, 3. 1, 2, 2, 3. See, never in a straight line. Here's the overbought now. 1, 2, because now the Fed's becoming exceptionally hawkish, so the market's discounting that hawkishness. 1, 2. Here's the release. 2, 3. Now the question is this the next impulse? If it's the next impulse, how high does it go? Now, the big unknown here, which is, in my opinion, extremely important and extremely underreported on, is the normalization of the balance sheet. Again, we've looked at that. The money supply has been siphoned out of the economy. On Friday, we're going to get a report on the sort of the first week of the quantitative tightening. Well, that's going to have an effect on rates. So despite how aggressive the Fed's going to be in terms of its rate hiking, that's not the question. That's not the question. The question is, how aggressive are they going to be in normalizing their balance sheet? That's a completely different question, and in my opinion, a much more important question. And it's been almost completely ignored by the media. They've got to get $9 trillion of capitalized assets off of their balance sheet, or at least half of that, to get to sort of historical norms. The quantitative tightening started this month on the 1st, and we're going to get the first report on Friday. So that's what we're going to need to be looking at. Take a look at the stochastic. Okay, so the stochastic is it's in the upper quintile. There's no such thing as being overbought with a stochastic. Yes, with the RSI there is, just by the mere mathematics behind it. But once you go into a extreme on the stochastic, that's not overbought, that's momentum. Okay, so you can see here's momentum, right? Here, this is momentum. This part of it, that's momentum. So we're in. So the point being here is anybody looking to for lower yields when the yields are in a momentum. You know, it's kind of it's hope more than anything. Go through to IEF. It's not to say it can't happen, right? Of course it can happen, but you're hoping that it's going to happen, right? You go to IEF, take a look at the momentum. Where's the momentum? Momentum's to the short side. Okay, you can anybody that goes long into bearish momentum, you know, good luck. Good luck. Okay, it's not something I would do, but take a look here. Okay, that's where the magic happens. So okay, so that's kind of what we're looking at, Anna. But your question yesterday, I think, was spot on. You know, let's take a look at the Bund. Okay, now the Bund's overbought. Okay, the Bund's overbought. So if it's overbought by the same thinking, we've probably got some sort of ceiling here. But any sort of pullback is probably going to be accompanied by the media saying, well, the ECB now doubting how aggressive they can be. Okay, so that's probably the rhetoric that comes out. The point is that Europe is headline inflation's over 8%, core inflation's around about 3.5%. They are going to get their inflation come hell or high water. They're going to get it to 2% somehow. So any sort of pullback here is probably just bond players, okay, bond shorts banking and their profits. Because if you were short Bund, all right, now's probably a good time to bank it. So what does that mean for us in terms of the market? It means that rates are still moving up. Let's go back to this this DAX. So we looked at the DAX, so we looked at the 4-year, okay, and trough peak, higher trough, higher peak. So now this is where it gets very interesting, because now we've got to see, well, are we going to get another higher trough here? I'm going to just put HT, I'll put a question mark. Okay, this is an HP here, right? So are we going to get the higher trough here? Well, we go back to that weekly, and what did we say? So, well, 15,000 is a level that the market has consistently looked at. Key reaction here, 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 key reaction here. There's a good probability. If I had to say to you guys, if there is going to be a key reaction, where will it be? So you'll say, well, based on where the market has looked at previously, no, this is probably a good bet. Is it a definite? No, it's not a definite, but there's a good chance. Okay, and so we have to watch to see if this is support turned resistance. Okay, so that's something that we can keep our eye on. So the obvious question is, well, what's happening here in the market? Well, these could be bear market rallies. Okay, we're just going to be very careful. Higher trough, higher peak, question mark. We'll go through to the DAX has actually been pretty strong on a relative basis. Go through to the Dow Jones. Let's go through to the Dow Jones. Okay, not quite as strong. Now we've got lower peak, lower trough, lower peak, lower trough. right? So, and now we can ask, the question here is, well, is this now the next lower peak? Question mark, okay? That's a different question to what we're asking with the DAX. Go back to the DAX. The question we're asking for the DAX is, well, is this sort of a higher trough, higher peak, okay? So the Dow Jones is much more severe in terms of a bear market. Now, that in of itself is significant. That in of itself is significant. We could say, well, wouldn't it be a good choice then to look at DAX over the Dow Jones? And on a relative strength basis, the answer to that is yes, probably. But if we are in a true bear market, and if this stagflationary is still to play out, if it's still to play out, remember what we've mentioned before, in a true bear market, okay, what happens, again, what I'm doing here is I'm just bringing up what's called a correlation coefficient. You've got three levels, 1, 0. I've got something interesting to say about this actually in a moment. I think what's interesting about this is just the practicality of it. I'll give you I read something on marketwatch.com this morning. So what happens with, let's just say we're looking at 2 instruments. Okay, we're looking at 2 instruments. So if you've got 2 instruments and they are perfectly correlated, that means they're moving completely in tandem with one another, is what we call there's an absolute positive correlation there. If the 2 instruments are moving in your direction, well, that's fantastic. Okay, but if they're moving against you, well, then you're getting a double hit. Okay. Then you've got 0. 0 is no correlation, so the 2 instruments will just move in whichever direction. You won't be able to pick. They may be moving in the same, they may be moving against one another, they'll just be all over the place. And then you've got -1, where you kind of move, your 2 instruments move in tandem but in completely opposite directions. This is there's no risk here. There's no risk, there's no reward. Whatever gain you're making with the one, you're losing with the other. So you're coming up net 0 here. So what's the big point about this is that if we are truly in a bear market, all instruments tend to win in a bear market. You just have to go to the charts for the global financial crisis. They're all moving in a similar direction. So if we're in a true bear market, then DAX will eventually move in the same direction as Dow, and the correlation will tend to 1. So just that's something to be aware of. So yes, of course, on a relative strength basis, the DAX is doing better. But if we're in a true bear market, that in of itself is not it's not a reason for safety. Just something I read on, so I'm not sure, do you guys know of something called ARC Capital, run by a fund manager named Kathy Wood? You guys ever heard of? It was really doing well, of course, when Bitcoin was doing well. She bet heavily on cryptos, and you know, she, so the idea here with ARC Capital is that it's been absolutely hammered left, right, and center. If you're an ARC investor, you're very unhappy. What a professional portfolio manager's got to do, okay? And this is drilled into you right from the beginning of CFA, is that when you're building a portfolio, you've actually got to try and get as close to 0 as possible. You've got to try and build a portfolio as close to 0 as possible. So, and you've got to spread it. So, in other words, there's been various studies. So some of the studies say a portfolio spread of 18 instruments is optimal. Some say actually 30 is optimal. I'm not quite sure which is the right answer. But what ARC Capital has done is they've got very strong concentration. So they haven't spread their positions, and all their positions are at correlation 1. Well, of course you're going to do well assuming that it moves in your direction. You know, better watch out if it moves against you, because everything's going to just fall, the bottom's going to fall out, and that's what's happening right now. You know, so it's just was an interesting article. All right, let's just take a look at ARC monthly tick. Rob says ARC monthly tech insights are excellent for ideas. I haven't read any of them. I'm just it's just a it's a huge mistake to concentrate on a correlation coefficient close to 1. As I say, you're going to do superbly. Of course, you're going to outperform when the market's going in your direction. But, you know, watch out when it's not moving in your direction. All right. What I think about the no catalyst theory, just to remind me on that, Anna, I can't quite remember that. Let's just see. Anna saying, is it a bear market rally? So I don't know. Nobody really knows. This could be a really good time to be buying. And of course, it can be a really good time to be buying. We're only really going to know after the fact, aren't we? Well, let's talk about that by bringing in the Copac indicator. Okay. Let's just see. Rob's got something here. The Bank of America is predicting 4,400 for the S&P, and then a classic bear market head fake, all down to the Fed shedding billions off the balance sheet. They predict that it won't change until there's a negative payroll print. Okay, so again, that's a really interesting comment you're making there, Rob. For me, what's interesting about it, for me, is just your last sentence, negative payroll print. Well, that's the hard landing, isn't it? That's your hard landing, isn't it? So that's very, very interesting what you wrote there. Okay. No real catalyst for rallies in terms of the big drivers. Oh, okay, I see what you're saying. Okay, so so that's again, I think a really good. I think that's a really good question. So there's two things on my mind, and then I think we can wind up for today. I'm going to, of course, try my best to answer that, Anna. But before we do that, let's just bring up a Copac indicator here. I think we're in a really good market to keep an eye on the Copac. And let's go to the US 30, because we can see that the US 30 was in that bear trend, lower peak, lower trough, lower peak, lower trough, right? So let's just bring up the FXCM US 30, which is our CFD for the Dow Jones. We want to go to the monthly, okay? So if you're using the Copac indicator, you want to use monthly. So just go there. And we can take out the RSI and the stochastic here. That's not what we want to look at. We're going to bring up something called the, what we're going to do is we're going to bring up something called the Copac indicator. I am a strong supporter of the Copac. It's not infallible. Like all indicators, there are false signals. But in terms of sort of seeing if there is value in the market, I think that it has given really good signals in the past. And let's just make it a little stronger here. Okay, so what you want to do with a Copac here, is you want to add in a 0. And we're getting pretty close, eh? We're really, really close here. Take a look at this. So in terms of getting to that value stage, we're not that far off, I don't think. Now, the way that the Copac works is you're looking for it to turn up from below 0, not to cross 0. You're looking for it to turn up from below 0. Very important. It's a very important distinction, because I have read websites where they say they're looking for it to cross 0. And look, I don't know if that works or it doesn't work, but that wasn't Copac's original intention. Okay, it was to turn up from below 0, and you can see that. Let's make this logarithmic, and you can see just the times that it's turned up. It's been really cool. I mean, you've had some really, this is, and it's always done on a monthly, okay? I think there's much better indicators for shorter term analysis, but for longer term, you can see how really good the moves are. And of course, I'm cherry picking because here's a false move over here. But this is the, what is this? This is the tech wreck. Okay, in the midst of the tech wreck there. This is a beautiful movement after the global financial crisis. This one over here was very good. You know, it's debatable if we went below. This is obviously COVID, and we're getting pretty close to that value. So if we get below value and it turns up, well, then we can start saying, well, there's probably a lot of value there. Now, it doesn't mean that we have to wait for it to go. If the fundamentals dictate, the market's going to move up. So you can see there's lots of times that the market's moved up without the COPOC being below zero. What the COPOC is actually there for, it's to try and time the bottom of bona fide bear markets. So that's the question: Are we in a bona fide bear market? Because then we should wait for it to turn up. Now, a really good example of a index that is under zero is actually the China 50. Okay, so let's just bring up the China 50, and I'm just going to bring it up. I used our instrument again, and I want to just I want to take I want to just take this to zero. All right, so you can see that we are under zero for the Shanghai Composite, and that to me is tremendously interesting. That doesn't mean, is it a buy signal? No ways, not a buy signal. But what it's telling you is that there is probably good value on the Chinese market. We've got to wait for this. It's flattened. It hasn't turned up yet. It may carry on dropping. Now, there's obviously heightened risk with the Chinese market. So don't take this as advice. This is pure education, right? But if it turns up, you know, the China 50 to me becomes interesting. The question then comes, am I prepared to take that risk? Because there's informational issues, there's regulatory issues, there are issues that come with this, but be that as it may, this is a place where you want to see the COPOC indicator. Go back to the US 30. Okay, we're not quite there yet. But if we get there, gee, that will be a really interesting market. All right, let me just see, there's a few comments here. Okay, sorry, and as catalyst, I'm going to come back to that now. I also heard someone say that there is need to be at least 2% unemployment rate for a recession. I'm just trying to think about that, and I'm not sure I agree. I'm not sure I disagree. I've got to give that some thought. 2% unemployment rate is very, very low. Like it's like I don't think it's ever been at 2%. I mean, that would be a boiling hot market. You know, so I've got to give that some thought. But I probably think it's too low. Just sort of first thoughts. Unemployment rate. Oh, sorry. You're saying unemployment needs to rise by 2%? Is that it? Am I reading it like? Is that the correct way to read it? So. Okay, cool. Yeah, but possibly. Let's take a look at that as well. What do I think of the CAPE ratio for judging whether valuations have dropped enough? What is the CA? So something PE ratio, the CA PE ratio. What is it? I've just gone blank. CAPE ratio, CA PE. PE ratio is always good for valuation, so I would probably say it's good. I'm not sure what the CA stands for. But the PE ratios, there's something called justified PE, Schiller's ratio. Oh yeah, Schiller's ratio is great. Okay, I mean, Schiller's, Schiller's a genius. Okay, so, but the PE, and there's something called, we're not going to go through it now, but what you guys can do is you can Google something called the justified PE ratio. You can certainly Google justified PE ratio. PE ratios are good for valuing terminal values. So what we did with that Apple, Rob, is with Apple we used the Gordon growth model. That's very academic. It's not always easy to use the Gordon growth model. In fact, for Apple, it was very difficult to use the Gordon growth model because your denominator, again, I'm not going to get into it, becomes less than 0, which is a problem. So the PE ratio would have been really good in that valuation. Cyclically adjusted PE. Yeah, I mean, I think that would be I mean, there's no ways I would say anything against Schiller. I've seen Schiller's PE ratio. It's good, and I'm a believer in valuations of PEs. Let's just answer Anna's question. She's got 2 questions here. So one's the unemployment rate, and the one is, of course, what about the catalyst? Let's just do the unemployment rate. I think that's the easier one to answer, Anna. And I think it goes back just to this. I think it goes back to this. Let me just think. It goes back to this chart over here. Bear with me. I've got to get my notes together. I've got all my codes typed here. So let's bring in the UN rate. Okay, which is, remember, it's U3. Okay, but it's fine. U3 is fine because U3, U6 tend to move in the same direction. Tend to. Okay. Of course, there are idiosyncrasies between them, but we'll just use the U3 here. And we've got a very low unemployment rate here. I mean, this is pretty close to full employment, 3.6%. And what we're going to do here is we'll just add the Fed funds rate on top of that. Let's just add the Fed's fund rate. I think, yeah, the very complex chart. Yeah, I'm trying to make it not quite as complex, but of course it's very much Fed funds rate. Let me just see something that looks odd here. What is looking odd is this one here. Let's take this one out. Yeah, okay, that's better. All right, so what we have here is the Fed's funds rate. I'm not putting in the inflation. We've seen inflation before, and we know it's high. So what I think we need to just concentrate on is take a look at the Fed funds rate, which is this turquoise, crossing above the unemployment rate. Okay. Now look what happens. So unemployment is a lagging indicator. The data is captured after the fact. Okay. So you can see that the Fed funds rate moving up, unemployment actually improves, but then it gets hammered because it's a lagging indicator. Okay. Take a look at this one over here. The Fed funds rate crosses above that unemployment, Anna. Here's a lag. See, unemployment's actually getting better here, and then it gets hammered. So there's a lag. Take a look where we are now. Okay, we've crossed. You guys see that? We've crossed. Now the question is there a lag? Does unemployment get a little better, a little tight, and then do we get hit hard? And that comes down to Rob's comment. The non-farm payroll starts becoming negative, doesn't it? So yeah, we've crossed. Now it's going to get really interesting, okay? Because to ignore the real probability of a hard landing here, just based. Remember, whilst we're actually making a statistical error here, which I think we must say in that there is what we call time series bias. I think it's called time series bias. In other words, the economic variables especially between decades, are completely different. Meaning that are you data mining? So the question is like, am I data mining? And the answer to that is yeah, probably. But this is the closest we can get to sort of stagflation in recent times. This is the first and the second oil crises, and we've got oil crises now. Okay, so based on similar economic fundamentals, and we know that the Fed is going to hike by 50 in a week's time. They're going to hike by 50 a month after that, probably 50 in September. So unemployment becomes a huge series, Anna, a huge series to watch. And we can only hope, of course, that it doesn't go this way, because we don't want it to go this way, because that's going to be stagflation. But we're going to have to watch that. So yes, your point is, I think, completely valid. Just let me know if I answered your question on that point. The last question I want to answer is what about the catalyst, which I think is a tricky, wage price inflation coming. So the last non-farm payroll, there was a bit of a release on that wage price inflation, a little bit of a release, but there's no doubt about it that there is inflation with wages, but it's behind core inflation. So your standard of living is getting hit right there because you're not keeping up with headline inflation, right? So what does that mean? It means that you're going to go back to your employer, and you're going to try and negotiate a higher wage because your standard of living is dropping, not because you're not getting higher wages, because inflation's killing you, right? But that, of course, leads to more inflation, and you get stuck in that spiral. It's very dangerous. That's what the Fed's trying to fight against. So I think they're trying tooth and nail to make sure that wage price inflation, it doesn't spiral out of control. Let's just bring this up. Okay, last for today, but I think very important, coming into Anna's question. She's asking, what about a catalyst? In other words, the idea here is, again, it ties in so neatly with Dow theory. It ties in so neatly with Dow theory. And Dow theory says there's three stages to a bull market, and there's three stages to a bear market. And so you kind of would have something like this. Okay, so that's your bull market. This is obviously just a theoretical diagram. Your stage 2 is always going to be the longest. Stage 3 is always going to be the most severe. So the sort of gradients haven't taken that into account. But you've got, and this framework, I think, is an extremely useful framework to apply to the market. Of course, again, it's a very simplified framework, but you're dealing with a highly complex monster here, so you're going to have to try and try and box it in as best you can, which you can't. But this is a fair way to try. So you've got something called your renewed confidence stage. Okay. Then you've got something called your improved earnings stage, which is going to be your longest bull market stage. Then you're going to have your rampant speculation. This is going to be the stage where most of the capital gains come from. It is also the most dangerous stage, because at this stage, things are too expensive, valuations are blown out. That's where your Schiller PE comes in, right? So that's your bull market. Then what happens with your bear market is you have, now I've got to be, what is the first stage of the bear? There's a very specific name to it. It is, I remember it. Okay, it's abandonment of hopes. Abandonment of hopes. Okay, so that's the first stage where we kind of just think about it like your crypto investors started abandoning their hopes of crypto. So I don't know if we hit that there. And again, I'm just using that as an example. Think of Luna. If you're a Luna holder, when did you lose hope, right? Then there is decreasing earnings. Okay, so this is where the economic conditions, this is your fundamentals now biting in, decreasing earnings. So we're actually seeing this now in the retailers, right? So we've had some really bad retails. We know that a lot of earnings are starting to kind of get hurt quite badly. But then the final stage, which just like the rampant speculative stage is your most sort of exaggerated in the bull market, you have your panic selling in your downwards. Now, how does Catalyst tie into that? So I think where Catalyst, in my opinion, ties in, and again, you know, I think there is a myriad of ways to interpret this. So, but I think if there is bearish news coming out, but the market's not reacting to that. In fact, prices are going up. Well, that bearishness is probably priced in. You're probably then getting a good, you know, a good indication that we're near the end. You probably see the Copac indicator under 0, and you'll probably have your pros buying good companies at really cheap companies, right? So there's your catalyst. The other way catalyst may come in is where there is sort of bullish news, the prices are going down. Okay, that means it's probably priced in, and there's forward adjustment that's taking place. So I think that's where your catalysts come in. The bear market, the lack of catalyst probably would be in your bear market rallies, but I think the fact that we don't have the Copac under 0, the fact that we don't have higher troughs for higher peaks, those are all signs of caution. The fact that on the fundamentals, they're not comfortable either. We've still got stagflationary pressures. We've still got very aggressive central banks. We've still got a lot of risk out there that needs to be priced in. We've got this balance sheet that needs to be normalized in terms of the Fed. We've got inflation seen in Europe that we've never seen before. It's all, we probably, again, this is subject to correction, we probably, I would expect here, and I'm not sure if I'm 100% correct there, but if I am, then perhaps there's still the panic selling stage to come. So let me know if that answers your question. Rob here just saying, worth reading an article on FactSet. Analysts are lowering their EPS estimates for Q2, but not lowering EPS estimates for second half of 2022. Okay, so we'll just have to keep an eye on that. Also, I think one possible reason for that, let me just see, did you guys get that? Did you guys get that? I think one possible reason for that, Rob, is just because bear markets usually are very quick. So maybe that's what they're foreseeing, and maybe we'll get into the renewed confidence there. Again, that's just conjecture. We'll see. We'll have to see how it plays out. Do I agree? There's been no real catalyst for the rate? Yeah, I would agree with that, Anna. I would agree. So that's the point. Is that you've got to be very, I think, quite suave or savvy with the way that we interpret the financial news that we hear, because it changes on a day-by-day basis. But we know that markets don't move in a straight line, right? They zig and zag. So if there's a correction in a downtrend, well, of course, the news is going to be positive. Because why would the market be moving up? Well, it's probably moving up because some shorts are banking profits, but nobody's saying that, right? So yeah, I would agree with that, Anna. All right, I think we can wrap up here. Any other questions before we wrap up? Rob, I'll put both of the YouTubes out today. So, all right. No questions. All right, guys, let's wrap up here and then have a good day, good evening. We'll chat tomorrow. Tomorrow, remember, we're going to have the crypto minute as well. Thanks, guys. Anna, yeah, Anna, if you can just perhaps just listen, I'm going to put it on Telegram, just listen to that, and of course, any questions, you just shoot me an email and I'll get back to you as soon as I'm able to. All right. Sure. Oh, okay, cool. All right, guys, I'm going to sign off, and I shall chat with you guys tomorrow.